Welcome to the video. To begin, let's set expectations clearly. Truly passive income at meaningful levels is rare, and that's why we're unpacking what actually works. First, we'll debunk the myth of effortless income. Then, we'll map practical paths you can choose depending on whether you have more capital or more time. After that, we'll convert goals into numbers and timelines so you can take deliberate action. Finally, we'll wrap with key takeaways and quizzes to reinforce your understanding. Here is our roadmap. First, we'll contrast myth and reality. Next, we'll explore two viable paths, one centered on capital and the other on effort. Then, we'll translate goals into numbers. After that, we'll lay out a simple 6-month action plan. Finally, we'll test your knowledge and close with concise takeaways. Let's move forward. Before we dive in, a quick disclaimer. This video is for educational purposes only and is not financial, legal, or tax advice. You should do your own research and consider consulting a qualified fiduciary advisor who understands your personal situation. Investments can lose value, and past performance does not guarantee future results. With that out of the way, let's proceed. Let's separate hype from reality. First, the idea that you can get high, reliable income with little or no effort tends to be a myth. In practice, you choose between two inputs, capital or time. If you have substantial capital, you can pursue diversified investments that require less active management but deliver modest yields. If you lack capital, you can apply more time and labor through semi-passive opportunities that may offer higher potential returns but require ongoing involvement. Therefore, the smart move is to pick your trade-off consciously and decide what you will actively manage, even if maintenance is light. Here's a direct comparison. On the left, option 1 leans on capital. You invest in diversified index funds or specialized dividend funds. You trade greater upfront capital for lower ongoing time and complexity. On the right, option 2 leans on effort. You engage in real estate, rent out assets, or build an automated e-commerce venture. You trade more time and management for the possibility of higher returns and more variability. Consequently, your best path depends on which scarce resource you have, capital or time. If you have a meaningful savings base and prefer minimal ongoing work, diversified low-cost index funds are often the simplest approach. First, broad funds like VTI and VXUS provide exposure to thousands of companies with low fees. Next, if income today is more important than future growth, specialized high-yield dividend funds can increase cash flow, though yields and prices fluctuate. Crucially, your income will be roughly proportional to your starting capital. There are no shortcuts. Additionally, automating contributions and reinvestment helps you compound steadily. Finally, manage risk by keeping fees low, staying diversified, and avoiding overconcentration in any one sector or security. Let's translate goals into numbers. To approximate $500 per month before taxes, at 2% annual yield you'd need roughly $300,000. At 3%, about $200,000. At 4%, around $150,000. At 5%, about $120,000. And at 8%, about $75,000. These are simplified, pre-tax figures that ignore volatility, fees, and taxes. They are meant to illustrate the scale of capital required. Consequently, if you have less capital, you may need more time and effort to reach the same cash flow. If you have more time than money, consider semi-passive options that require substantial upfront effort. First, with real estate you must handle repairs, vacancies, tenant relations, and record keeping. It is essentially a business. Next, renting out assets like vehicles can generate cash flow but involves wear, insurance, and downtime. Alternatively, you can build a semi-automated e-commerce store where systems reduce effort over time, but setup is intense and ongoing optimization is necessary. Additionally, digital products can scale, yet they rely on marketing and iteration. Therefore, track your time and returns. If the effort-to-reward ratio deteriorates, be ready to pivot. This pie chart illustrates that returns typically come from multiple sources. Capital contributes the largest share, representing the money you can allocate upfront. Time and labor represent the ongoing work you put into managing projects, businesses, or property. Skill or edge represents knowledge, process, or execution advantages that improve outcomes. Finally, luck plays a smaller role but still contributes to variability. Consequently, understanding and balancing these inputs helps you choose a path that aligns with your resources. Here is a practical 6-month plan. First, define a concrete monthly income goal and be honest about your available capital and time. Next, choose your primary path: capital-heavy investing or effort-heavy building. Then, set up accounts and automation to remove friction from saving and investing. After that, write a short investment policy statement so you have rules to follow under stress. Subsequently, either implement your diversified allocation or launch a small pilot project for your chosen side business. Finally, track key performance indicators, review results, and iteratively scale what works while cutting what doesn't. Quiz time. Which statement is most accurate about so-called passive income? Option 1. Truly passive income at high yields generally requires either lots of capital or lots of upfront work. Option 2. You can get high, safe yields quickly without capital or effort. Option 3. Dividend ETFs guarantee your income rises every single year. Option 4. Rental properties are hands-off once you close on the purchase. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the first option. High, reliable income is typically the result of either substantial capital or a great deal of upfront work combined with ongoing management. There is no free, high-yield, low-risk solution that requires no resources. Next question. To target about $500 per month at a 4% annual yield, approximately how much capital do you need before taxes? Using a simplified calculation, your options are $60,000, $75,000, $150,000, or $300,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $150,000. At 4%, $150,000 generates about $6,000 per year, which is roughly $500 per month. This is a simplified, pre-tax illustration. Real results vary with taxes, fees, and market fluctuations. Here are the key takeaways. First, there is no magic faucet. You must trade either capital or times. Second, if you choose the capital-focused path, diversify, automate, and accept that yields are proportional to capital. Third, if you choose the effort-focused path, build systems, manage actively, and expect variability. Fourth, translate your goals into concrete numbers and timelines, then track and iterate. Fifth, pick a strategy you will actively manage and commit to following your rules. In summary, meaningful passive income is not effortless. Decide upfront whether you will trade capital for lower maintenance or time and labor for potentially higher yield. Then, set specific targets, automate your plan, and review regularly. Finally, adapt based on data rather than emotion so your approach remains sustainable over time. Thanks for watching. If this helped you rethink passive income, please like the video, share it with someone who needs it, and subscribe for more practical money strategies. Finally, tell us in the comments which path you're choosing and why.